Welcome to this special joint edition of the Consumer Finance Podcast and Payments Pros. I'm Chris Willis, the co-leader of Troutman Pepper Locke's Consumer Financial Services Regulatory Practice, and today I'm joined by the host of Payments Pros, Keith Barnett, my other co-leader of the Consumer Financial Services Regulatory Practice, Mark Furletti, and our partner, Jason Cover, to talk about the future of earned wage access products after the rescission of the CFPB's last administration guidance on that subject. But before we jump into that topic, let me remind you to visit and subscribe to our blogs, troutmanfinancialservices.com and consumerfinancialserviceslawmonitor.com. And don't forget about our other podcasts. We have Unauthorized Access, which is our privacy and data security podcast, the FCRA Focus, all about credit reporting, Payments Pros, the Consumer Finance Podcast, and of course, Moving the Metal. And all of those are available on all popular podcast platforms. And speaking of those platforms, if you like this podcast, let us know. Leave us a review on your podcast platform of choice and tell us how we're doing. Now, as I said, you know, obviously from reading the news and from listening to this podcast, that the CFPB under the current administration withdrew close to 70 pieces of informal guidance a little bit earlier in May of this year. And we're having a series of podcasts that will analyze the impacts of the withdrawals of those various pieces of guidance. And today we're going to be talking about where earned wage access products stand after the withdrawal of guidance pertinent to that subject. And as I said, I'm joined by Keith, Mark, and Jason. So gentlemen, thank you for being on the podcast today.
Thanks, Chris.
Mark, let me start with you. If you don't mind, just give the audience some background from which to appreciate the magnitude of the developments that are going on. Tell us about the history of earned wage access as a term and the types of products the term covers.
Sure. So, Chris, we started seeing these products emerge, I'd say, not quite a decade ago, but a while back. And historically, these products were employer-based. And let me explain what I mean by that. Imagine that there is an employer and an employee is set up to get paid every 2 weeks by that employer. The employee, after working 1 week, has earned the wages for that week. And so to the extent the employer was to give the employee access to those wages, that's not an extension of credit. That's not giving the consumer money that they have not already earned. And so the theory was that these were not extensions of credit subject to lending laws, because you were giving employees access to money that was already technically theirs, just hadn't yet been paid. The next iteration of this came through payroll processors. So we started seeing payroll processors partnering with employers to facilitate these transactions. And again, that's basically the same theory, i.e., the employee was getting access to wages that they had already earned. And then kind of the next phase of this was having third parties who are neither employers nor payroll processors start to offer these types of advances. And in that case, the theory changed a little bit. It wasn't that they were giving employees access to money they had earned, because they weren't quite sure. They're not the employer, so they weren't able to necessarily know how much the employee had earned, although sometimes they could estimate it by looking at deposits into their deposit account. But rather, they set these things up to not be credit because there was no obligation to repay. So that is, the employee was given the advance, but there was not an obligation on the part of the employee to repay it. Although if they wanted to get future advances, they would have to. And so a hallmark of credit is an absolute obligation to repay. And so when there is no such obligation, it should neither be credit under federal law nor under most state laws. Now we'll talk about later, Keith will talk about some expansion of state laws to cover transactions of this type, but certainly it's like no obligation to repay, and then sometimes giving employees access to money they've already earned was the basic concept. And then two other things just to mention as background are tips and expedited funding fees. So a lot of the third-party based products are offered by companies that, because their position is that there's no obligation to repay, there is an optional tip that the provider asks the consumer if they want to pay in order to basically compensate the provider of the advance. It's not a finance charge and it's not interest because it's not required, arguably, but that's one of the main forms of compensation for these. That's why people do it, particularly the third parties, as opposed to just being an employee benefit. And then there's also expedited funding fees are a key feature of these products. That's where there might be a way of the consumer getting the advance faster by paying a fee. And so, again, the argument would be that an expedited funding fee is not interest, it's optional, it doesn't have to be paid. So, at a high level, that's kind of the types of products and the theories, at least under consumer credit law, for how those products are generally offered.
Mark, just to elaborate, one other common feature would be like a membership fee. Like sometimes these products are offered with a broader range of suites and services. And then two other like important characteristics are how the payments are paid, even though they may be non-recourse or no obligation. For the employer-based programs, those would be deducted from your payroll, right? So the wages that were earned but not yet dispersed are deducted from the 2-week payment that Mark referenced. And then for non-employer based, they're typically recovered through some sort of payment authorization, whether that's ACH debit or sometimes folks have a checking account with the party offering the EWA product. But typically there's a one-time authorization of some sort to recover those funds that are advanced.
Okay, thank you, gentlemen. Now, the trigger for today's episode is the withdrawal of an advisory opinion on earned wage access products that the CFPB had issued last year. That, however, wasn't the CFPB's first foray into this issue. Can you tell us something about how the CFPB has weighed in on these types of products over the years?
Yeah, Chris, so this actually it's now ancient history. Way back in 2020, there was an initial advisory opinion offered under the first Trump administration. And that tried to distinguish between the two products that Mark referenced broadly, right? The employee-based versus direct-to-consumer products. So that advisory opinion tried to quote unquote codify or make clear that employer-based products involved like an agreement with the employer in it were not credit under Regulation Z and not subject to those disclosures. And it identified a couple conditions of those. Those were providing the consumer with no more than the amount of accrued wages earned, provision by a third party fully integrated with the employer, no consumer payments beyond recovery of the amounts in the payroll deduction, next paycheck, and then no other recourse or collection activity, and no underwriting or credit reporting. So a lot of the similar features, right? But the crux of it was that employer-based program. It remains silent about the direct consumer or third-party earned wage product. So that was left kind of as something, open in the air. And then shockingly, of course, it was rescinded by the Troutman administration sort of in late January, one of their last final acts. And then you alluded to this, Chris, the Troutman administration was also busy. They had a very different opinion on how EWA worked. That was offered by them last summer. I think Mark and I and Keith, I believe, also did a podcast on that way back when. This, again, shockingly reversed the previous opinion. And I think, Mark mentioned that all of these features are common to things not being credit or someone offering them not being a creditor, and that obligation to repay being the crux of it. The first thing that this interpretive rule did was say, hey, if there's any kind of way to recover the payment, whether that's a payment authorization, a payroll deduction, et cetera, that's actually an obligation to repay, even if it could be canceled. And then it sought to clarify some of the ways that this is economically driven that Mark mentioned, like the expedited funding fees, tips, and the CFPB characterized those as finance charges under Reg Z that require disclosure. So you're a creditor requiring disclosure, and now these are finance charges requiring disclosure. And I think the podcast has me being shocked and outraged that they would classify these types of payments as something that's imposed on the consumer as an incident to an extension of credit, which is the definition of a finance charge under Reg Z. If something's optional, it's hard to see how it's imposed as a condition to credit. So then we're back to square circle. This month, it's May right now. Maybe it isn't when the podcast is released, but the current Trump administration has rescinded that interpretive rule. So at the federal level, there's no guidance to go by. And even if there were, it seems like it flip-flops every couple of years regardless.
Yeah, well, thanks for telling us the history of this sort of, I'm going to call it a regulatory flapjack, Jason, as it's been flipped over again and again and again through subsequent administrations. But in all seriousness, with things back to ground zero on this issue at the CFPB, what other regulatory landmines exist with these products?
As of the date of this recording, there are about 13 states that have either enacted EWA laws or issued state AG opinions concerning EWA. Many more states have proposed EWA laws that may or may not make it out of the state legislatures this year. But irrespective of whether or not these laws have been enacted, there is a common theme amongst the state laws and state AG opinions that affect how fintechs, payroll processors, payment processors will do business in the states, in addition to those who are just providing EWA access. There are concerns, as Mark mentioned earlier, that EWA is tantamount to payday lending, right? So you have these state laws that limit the charges to employees. And you also have EWA providers that have to make disclosures related to these costs. And the EWA providers in some of these laws may not ask for information that is tantamount to asking the employee to apply for credit. Similarly, along those same lines, some of these laws prohibit, for example, reporting of information to consumer reporting agencies. And some of these states require licensure or registration by the EWA provider. Now, for what it's worth, there are some states that exempt employers from the law or payroll providers from the law if the payroll processor is not performing the EWA itself. And some states have exempted banks from the EWA laws. With respect to how these state EWA laws have affected or will affect fintechs and processors, to be clear here, the state laws, for the most part, address two types of EWA products: those that are considered to be employer integrated and those that are considered to be employee integrated. Many techs and processors, for the most part, as Mark mentioned earlier, have stayed away from contracting directly with the employee. And instead, their contractors are directly with the employer, not the employee. And they only provide the tech access to the employer and nothing else. And the way this works is that the employee has access on an app powered by the fintech or the payroll processor. The flow of funds goes from the employer to the processor to the employee. The funds do not originate from the processor or the fintech provider to the employee. And even if the funds do not originate from the fintech or processor, the fintech or processor may create some sort of money transmitter licensing issues in some states if the fintech is in the flow of funds. So there will be some instances in which the flow of funds will be directly from the employer to the employee, some of those traditional EWA access that Mark was talking about earlier. But also getting back to this whole whether or not this is going to be credit thing, the way processors and fintechs have been able to get around this is that, like I said earlier, they've been only contracting with the employer, and they will also only charge the employer for the services and not the employee. And in some instances with our clients, if an employer cannot afford to make the advances, some of our fintech clients do provide a program through which they advance funds to the employer and charge the employer a fee for the advances. But if the fintechs are doing that, they just need to make sure that they comply with state lending laws. Mark, do you have anything else to add to that?
I would just say that in terms of landmines, it remains mostly under state law. I think you still have an issue under federal law of the absolute obligation to repay. We would advise clients to, if their business model is based on that, as opposed to the employer model Keith was just describing, that folks steer clear of the absolute obligation. And then in terms of the specific state legislation, there's a few trends. There's like states that think EWA is good. They pass what I would call like enabling legislation that permits the product. It may license it, but generally it's permissive and requires disclosures and prohibits certain practices that the legislature thinks is bad. So those are kind of like permissive or good laws for providers. And then you see some good regulatory developments. So you see like a state AG, possibly like the Arizona Attorney General, issuing guidance that EWA transactions are not consumer credit when properly structured. So that's good. And then we kind of see bad things. So Connecticut, as an example, amending its law to cover these transactions as credit under a small loan law, for example. Or you see some negative regulatory guidance out of a state. And then you have a bunch of states in the kind of final bucket. So you have like the states that are doing good things, enabling it, the states that are doing bad things to shut it down. And then we have states that are doing nothing. And in those, you just want to be conscious of what the usury law says and the types of transactions they cover to ensure that if it's no obligation or it's employer-based, that there's no argument, it's not subject to some state statute. So to Chris's initial question, like, are there still landmines? Yes, there are. Most of them are at the state level, but you still need to concern yourself with federal law.
Okay, thanks. And Keith, in addition to the sort of EWA specific laws that you all have been talking about, are there any other state laws that the industry should be aware of with respect to EWA regulation?
Yeah, some of my clients have encountered this, at least from the payments part of it. And not surprisingly, the states that they encounter are California and New York. Let me give a couple of examples. So in California, well, I mean, this happens generally, but there are times in which an employee will be overpaid. There could be a clerical error or for other reasons. And in California, they have a state law under the labor code, I believe it's section 221, that prohibits employers from clawing back or deducting wages that have already been paid to employees without express permission from the employee. So the employers would actually have to take the employees to court in order to get the overpaid wages in the event the employees do not provide such permission. And this can lead to several roadblocks, as you can imagine. Let's be clear here. The EWA employees are hourly employees who may not still be at the job when that error is discovered, or they may not have the same bank account, or if they're still on the job, under California law, the employer cannot retaliate against the employee for pushing back on the employer's request for some sort of clawback. So the employers who provide EWA should not allow, in order to deal with this, they should not allow employees to obtain 100% of their wages early. There should be some sort of limit to avoid this from happening or to keep this from happening. Maybe something like 70% or something like that, so you don't run the risk of overpaying an employee. Another issue that's come to mind, it's been making the news lately, and this is in New York. They have been dealing with state lending laws and wage assignment laws when it comes to EWA. And in fact, there's an EWA provider that is currently involved in a legal dispute with the New York Attorney General. And she alleges that this provider's practice constitutes illegal payday lending with, as Mark mentioned earlier, with fees and tips leading to what New York describes as impermissible annual interest rates. And the New York AG is saying that the EWA provider's most common product, which is a 7-day paycheck advance offered for $2.99, actually reflects an annual interest rate of more than 750%. And according to this lawsuit, the EWA provider contracts with the employees' companies, so their employers, and require the employers to send the workers' paychecks directly to the EWA providers first on payday, which would allow the providers to deduct all amounts that is owed before passing on the remaining balance to the employee. And in that respect, the New York Attorney General alleges that this EWA provider is violating New York's wage assignment laws. So you have several things that we're looking at here, at least in California, the inability to easily claw back overpayments. And in New York, you have state lending laws and wage assignment laws to look out for as well, even when there isn't direct legislation involving EWA.
Makes sense. But I assume there's also an overlay of potentially private litigation here. Mark, Jason, what's been going on? What trends are there in private litigation with respect to EWA products?
Chris, I think and this is even, in the last couple of months, there just seems to be a rash of Military Lending Act class action litigation popping up. And if you Google military lending EWA cash advance, you'll find a bevy of websites sort of attempting to collect folks for their class actions. But, essentially, they're just getting back to the core concepts again, right? They assert that these products are credit, and they assert that all of the fees and charges associated with them are finance charges subject to military APR, so above 36%, and then assert a class So that's something to keep an eye on if you're interested in these products. We've seen that pop up recently. And then just rewinding slightly, I think at both the state and federal level, state AGs, FTC, there has been focus on the enrollment process itself and the so-called dark patterns, and then sometimes what's going on behind the scenes with things. One of the earliest criticisms of these products came from New York, shockingly enough, and they alleged that some of the providers were tying the amount that they would subsequently give you after your first advance, whether or not you tip. So if you give a nice tip, they'd grant you more access to credit the next time around. If you didn't, they might give you the bare minimum. So there's, outside of just that product structure, there are some other things to keep in mind when you're thinking about these products and designing them.
Okay, thanks, Jason. Keith, back to you. You've talked about a wide variety of state laws, both EWA specific and these more general laws like labor and employment related laws. How are those state laws affecting the manner in which fintechs, payment processors, and payroll processors are approaching EWA products in those states?
They're paying very close attention in those states and have reacted accordingly. And so the payroll processors, for example, who want to provide EWA access to employers, try to make sure that they are not actually the ones that are sending the money for several reasons. One, in some states, you could run afoul of money transmitter laws. But second, and most importantly, at least with respect to EWA, is to make sure that they're not required to perform all of these disclosures that are required under the laws or do any type of licensure or registration. And the same thing with the fintechs as well. They are trying to provide mechanisms through which they can still make money, but also not have to go through any of the registration requirements or the disclosure requirements.
Got it. How do you think, in general, the recent lawsuits from state regulators will affect processors and fintechs who provide EWA access to both employers and employees? In other words, where do you see the future of EWA with all of this in the mix?
I see for the more careful processors and fintechs, they will continue to refrain from offering the products directly to employees and stick with the employer-based model. But in doing so, stick with the employer-based model whereby the employer is just using their tech in order to provide the early access, as opposed to providing money directly to the employees or charging the employees directly. So instead, indirect charges to the employers. We also expect to see more legislation. I mean, there are like 20-something states that have EWA legislation in the hopper requiring disclosures or preventing providers from asking for information that would be an extension of credit, or other legislation that is designated to prevent advances from becoming loans. So our fintech and payroll processing clients are watching these things very closely in order to avoid those potential landmines.
Makes sense.
Adding to what Keith said, on the other side, the employee-focused side, I think the no obligation, that's the safest way to go on that side, is to continue to ensure that consumers can cancel the transactions so that there's no absolute obligation to repay. And that should, in most states, keep folks out of the consumer credit laws altogether.
Okay. Well, gentlemen, thank you very much for being on the podcast today to discuss this important and evolving issue. We're, of course, going to continue to watch it. As you can tell, the three of these lawyers have very carefully, and you'll hear updates about this as they develop both on our blogs and on this podcast. And of course, thanks to all of our listeners for tuning into today's episode. As I said, don't forget to visit and subscribe to our blogs, troutmanfinancialservices.com and consumerfinancialserviceslawmonitor.com. And while you're at it, why not visit us on the web at troutman.com and add yourself to our Consumer Financial Services email list. That way we can send you copies of the alerts and advisories that we produce from time to time, as well as invitations to our industry-only webinars. And of course, stay tuned for a great new episode of these podcasts hitting your podcast feed soon. Thank you all for listening.
Copyright Troutman Pepper Locke, LLP. These recorded materials are designed for educational purposes only. This podcast is not legal advice and does not create an attorney-client relationship. The views and opinions expressed in this podcast are solely those of the individual participants. Troutman does not make any representations or warranties, expressed or implied, regarding the contents of this podcast. Information on previous case results does not guarantee a similar future result. Users of this podcast may save and use the podcast only for personal or other non-commercial educational purposes. No other use, including without limitation, reproduction, retransmission, or editing of this podcast may be made without the prior written permission of Troutman Pepper Locke. If you have any questions, please contact us at troutman.com.